The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey, everybody, this is the Tax Lady, and this is our hour to talk taxes. We're going to keep you up to date on what's happening with the legislation going through the House and Senate regarding tax changes. And if you listen to the financial guys, and you were kind of listening to them complain about it. We know the scoop, and we're here to help you. I'm Esther Gulius, the Tax Lady. Our phone number in studio is 8030930. 8030930, star 930 on a cell phone. You can text us at 716-8030930. And I have Christopher Fabian with me. Hey, Chris.
Hello, Esther.
Hello, Christopher. And today's kind of a big day for you.
It is. It's our daughter's wedding shower today. So hopefully there are no showers.
There was little ones on the way
little ones
in.
coming in,
Yeah.
but yeah, it's a very exciting day for the Fabian household.
Right, that's great. And so it's really interesting because back in the day, I never wanted to go to a shower because they were so boring. And now the men come with the women.
Yeah, it's a co-ed shower.
And it's like a sit-down dinner, and it's really interesting. So anyway, our phone number is 8030930, 8030930, star 930 on a cell phone. Text us at 716-8030930. I was listening to the financial guys on the way in, and they were talking about the one of the things that are being proposed is the no tax on tips. And they were saying that nobody declares tips. Is that true, Chris?
No, they have to. I mean, nowadays,
you have to.
With the point of sale terminals, they have to. I mean, and, you know, I know a lot of the servers out there, bartenders out there don't want to hear this, but if they don't claim all their tips, they're hurting themselves later on in life because it's impacting their Social Security.
Right.
You know, so you have to pay an extra 15% on $15,000. Well, okay, so that cost you roughly
$2,800.
Something like that. But going forward, that could mean an extra $300 a month
when you start collecting
Social Security.
But here's the thing: they allocate tips to servers
if
anyway.
you don't claim it.
So if you don't claim it, they allocate it to you. So this tax on tip income that they're proposing in no taxes on tip income that they're proposing will save people money, but it won't save them what they think.
Right, because it's only going to be an adjustment to income.
Right.
So they're still going to pay Social Security and Medicare tax, and it's only going to limit it to like $20,000.
Actually, I think it's 25. So that's what I want to talk about. So the bill from the House is gone into the Senate, and the Senate is negotiating, and that's part of what we want to talk about. But we got a call that just came in. And by the way, at 8030930, 8030930, star 930 on a cell phone. You can text us at 716-8030930. And so I have Chris. Hi, Chris. How can we help you?
Hi, Esther. Okay, so I hope I can get this out correctly and clearly for you. So when my understanding is that when, say, an elderly person or older creates a irrevocable trust for their children to and that to protect it from Medicaid, should there be issues down the line. So after the 5 years, it's protected. And then at the time of death, it's goes to the children, and they have a stepped up basis at that time on the value of the property. Is that approximately correct?
No.
You have to.
Okay.
No, because last year, the Internal Revenue Service said if you have an irrevocable trust unless it's written very specifically, and Chris will give you the language,
Yeah, if I
you
s-
will not get a stepped-up basis on the property.
Yeah, I would ask the lawyer, because we're not lawyers, I would ask the lawyer who set up the trust, is the correct lingo in there where we do get the stepped-up basis? Because you don't want any surprises later
Because
on.
I understand the only way you're going to get a stepped-up basis is if the property goes through an inheritance. It's got to be listed as inherited property, or else you won't get the stepped-up basis.
Okay, so now here's the secondary, more complex question. So, in the event of a marriage with the child who before or during the marriage the property was transferred into an irrevocable trust for the spouse, is that considered marital property at that time for the purposes of taxes?
I can't answer that. You got to talk to an attorney.
Okay, fair enough.
I don't want to give you bad information, but while you're talking to the attorney, ask him about the stepped-up basis, because there was a major change for trusts, unless specific language is put in there authorizing it to become the inherited property with a stepped-up basis. So you got a couple questions to talk to your attorney about, Chris.
Oh, okay, very well.
All right, right. Thanks for calling. I'm Esther Gilius, the tax lady from EG Tax. 8030930, 8030930, star 930 on a cell phone. Text us at 716-8030930. So, I mean, that's pretty much what they're saying,
Yeah.
right?
Yeah,
That the property has to go through inheritance,
correct.
right?
Yep.
Which seems to, if it's hanging out there like that, then couldn't Medicaid get it?
I
If
know
an
it's
asset?
really
So,
it's the wording is very
Right.
That's why you got to make sure the wording is correct.
all right. So right now, what's in the House, and I'm going to tell you something's going to get passed here. So it's either going to be a modification of one or the other, but we are moving forward in this direction. So the senior deduction, if you guys have listened, you know that I thought that they really should have modified taxable Social Security, because had we really just taken the floor that they give of $25,000 or $32,000 if you're filing a joint return and applied the cost of living increases every year, that floor would be like $100,000 now. But that floor is the original floor way back when it was first put into tax law of $25,000 if you're single, $32,000 if you're filing a joint return. So what they did because Trump had campaigned on this, what they did was they said, okay, we're not going to change that floor. We're still going to make Social Security taxable, but we're going to have an adjustment to seniors. The Senate says $6,000. The House says $4,000. So it's going to be, maybe it'll end up being $5,000, but seniors should know that this is really going to save them some substantial money.
Yeah. I mean, if it's $6,000 per person, that's an extra $12,000 standard deduction.
Right.
That's
Absolutely.
incredible.
That is. The child tax credit, the House had said that they wanted to change the child tax credit to $2,500 for children under the age of 17. The Senate has said $2,200. But it's still another $200 increase. Right? So, again, they're negotiating that. For New Yorkers, they just don't like New Yorkers because it's a high tax state, and they must think that conservatives can vote out the liberals. I think that's kind of tough in New York State. And as a result, even though the House had said they wanted a $40,000 SALT deduction, the Senate has kept it at $10,000. But, I don't know if it'll get through the House then when it goes
because
back.
it's got to go back to
Right.
the House.
So,
Because I'm just a bill. A lonely old bill.
That really, that little thing, I'm just a bill on Capitol Hill, that really taught me a lot about how bills get passed.
Yes.
Right?
Yes.
Okay, I'm Esther Golias, the tax lady, 8030930, 8030930, star 930 on the cell phone. I can see the little bill. 716-8030930 is our text hot text line. We're going to take a short break. We'll be back on the other side. Hey to us, you are family. I'm Esther Golias, the tax lady with Christopher Fabian, and we're here to help you with your taxes. If you have any questions about the big, beautiful bill, we can keep you abreast of what's going on so that you can plan. And I will tell you, one of the things I'm going to talk about later on in the show is like this is a good time to do mid-course correction because half the year is gone. We have half the year left. And if you're somebody this year that found that you were behind the eight ball, now's the time to find out. And we're going to go back to the phones and talk to my favorite guy from the islands. That's Kevin. Hi, Kevin.
Oh, yeah. Good day, folks. How you doing?
I'm good. What's new?
Well, here's what I got a question about. I know it shows here that your full benefits, if you wait until 70 to take out Social Security, you get your full benefits. Mm-hmm. And the two questions I have, first, the big, so-called big, beautiful bill, were they successful in passing it where they will not tax one's Social Security?
No, they kept that in. They kept the Social Security in there. But are you married, Kevin, or are you single?
No, I'm single.
Okay, so what they are proposing, the House said will give anybody over the age of 65 a deduction of $4,000. The Senate has said we'll give them a deduction of $6,000. So in essence, if you had some taxable Social Security, this is going to cover anywhere from, if you're in the 10% tax bracket, $400 or $600 if you're in the 10% bracket, and if you're in a higher bracket, it'll cover a little more, but it'll at least relieve some of the burden on seniors who are paying taxes on their Social Security.
Right, but I mean, this could be changed, of course, by the stroke of a pen if,
Right, they could vote it in now, and then 4 years from now, you're paying tax again, and then 4 years later.
Well, and that's what happens with tax law all the time,
yep.
Right? I mean, they put it in, change it. Part of what they're also proposing is the tax law changes that took place originally in the Trump administration that were expiring the end of this year to make those permanent tax law changes. So that's another thing. But right now, no, they're still keeping Social Security taxability the same, but you'd get an extra standard deduction of either $4,000 or $6,000, depending upon which branch of the legislature wins out.
Okay, and last question here, my second question, is that, I know that one can take out Social Security early, right? And if you still work, you only get a certain percentage. But here's what happens. When you get to age 70, will you then be getting your full benefits, or has that been
No,
cut?
if you take it early, all right?
Mm-hmm.
If you're taking Social Security at 62, for instance, and that's going to be changing, modifying a little bit to 63, then you're going to get your benefits with a little penalty, all right? So they're going to penalize you for taking it early. If you wait to normal retirement age, which is right now around 67, then you're going to get what's considered full retirement benefits. If you wait to age 70, then you get 8% a year or 32% increase over what you would have gotten at full retirement age. So full retirement age is the benchmark. It's 32% higher if you wait to 70, and it's lower if you take it at 62. The truth of the matter is, though, if you wait to take your Social Security to age 70, the money that you're going to get, the extra 32%, is really the money they didn't pay you in the first place. Because if you were supposed to get, let's say, $30,000 a year, and you wait 4 years, that's $120,000 you didn't take. And so the 32% that they're giving you, they get to take it out of that kitty that that you didn't take the money from. So you actually break even when you're about 83 and a half.
Oh, wow. Okay. Well, depending on what happens the next couple of weeks, a lot of people
Well,
might
we'll
be
keep
cashing in.
you posted.
Okay, take care.
All right, thanks. Thanks for calling. Yes, sir.
Sorry, go to Kevin's call. I had somebody come in this week, and he's 60 years old, disabled, and he wants to wait till he's 66 to get his Social Security. And I'm like, why? Well, because I'll get my full retirement. I'm like, yeah, but you're disabled. You can't work. So why
Isn't
aren't
he on
you?
Social Security disability?
No, he just got hurt a year ago. He's been on workman's comp. I said, apply. The worst case they can do is say no, because your Social Security disability is higher than what it would have been if you were to take it at 62. And he goes, yeah. But I'm just planning on taking money out of my IRA.
My taxable accounts,
right? And I'm like, why would you do that? You could save that, because if something happens to you, your wife will have your IRA.
But if you didn't take your Social Security at the funeral, they don't walk up to you and say, hi, I'm the federal government, and you didn't take $100,000 and we want to give it to you.
Yeah. So it's a lot of planning, It is.
I mean, obviously, if everybody knew when they were going to pass on, the planning would be perfect.
Yeah.
But since we don't know, and it does take till 83 and a half to break out even, if you think you're going to have a big party on your 84th birthday, well, then,
serving
wait.
Jell-O and pudding.
Right. I'm Esther Gullius, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. You can text us at 716-8030930. We got a text there, right, Chris?
We do. Good afternoon, EG Tax. I know you get fined if you don't have enough taxes withheld from your wages during the course of the year. But what if you get a K-1 distribution from an estate you are not expecting to get, and you are underpaid because of that? So do you still get fined?
Well, the thing is, there is an exception to penalty. And the exception to penalty would be if you paid in as much in, let's say, 2025 as your liability was in 2024 in withholding to cover that liability. And this year, let's say you owe an extra $10,000. That exception to penalty will save you because you had met one of the exceptions to penalty. And so you would not have to pay a penalty.
Right. And also,
but you have to fill out the Form 2210.
Yeah, the 2210, the back page is very complicated. They want it broken down for the first 3 months, then the first 5 months, then the first 9 months, and then so they can see how the income is earned throughout the year to see when it came in, and then they would allocate the penalty accordingly.
Right. But again, if you paid in
your last year's tax figure,
you'd be in good shape.
Correct.
Okay, but that's what's really important, and that's why this time of year I know it's wonderful and it's hot out and people are swimming, and although it's overcast, and you'd think, who wants to do taxes this time of year, right? Well, I mean, sometimes it's really a good thing because you don't want to just go into the sunset into October and then you find out that, oh, gee, I should have changed my W-4 at work, or I should have changed my withholding from my pension or Social Security or whatever it is, and you don't have time to catch up.
Right. And don't keep pushing it off year to year to year, because if you do owe, the IRS will know it, and they will send you letters, and the penalties and interest will keep accumulating.
Yep.
But if you have a refund, the penalty for not filing when you have a refund is after 3 years, they keep it.
You lose your refund.
You lose your refund. And I've seen people lose $5,000. I did one. I still remember. I tell the story all the time. I had a gentleman, I did like 15 years worth of returns, and he lost $40,000.
Wow. And and everybody's a different personality type, and we are completely non-judgmental because we just want to get people up to date. But the thing is, some personality types are, I'll do it tomorrow.
Yep.
I mean, like my mother was the kind of person, like she got there an hour ahead of time. Unfortunately, I think I take after my mother. But there are people that they're always a day late and a dollar short.
Yep.
That when it's your taxes really can hurt you.
Yes.
It can really hurt you. Anyway, I'm Esther Gullius, the tax lady, 8030930, 8030930, star 930 on a cell phone. Text us at 716-8030930. All right, one of the other things that you see stuff on TV all the time about all the people that are going to get tossed out of Medicaid. They're going to get tossed out of Medicaid because they're illegals.
Right.
Or they don't work. So, and I know people have bleeding hearts, and I don't want to see illegals not have Medicaid too, but I'm going to tell you, I had a lady the other day that was doing her tax return. She's a hard-working woman, makes about $52,000 a year, so she can't get a subsidy, and she's going broke because of her medical bills. Had she made about $25,000 less, then she would have gotten a full subsidy and been on Medicaid. And it's so sad. And it's so sad. Here she is, a hardworking U.S. citizen. But here we have people that are non-American citizens here illegally, but they get Medicaid.
They get better health insurance.
That's right, because it has no deductible. Right. So anyway, so that's what they're proposing, that if, like, you're here illegally, you don't get Medicaid. Also, if you have children under the age of 14, you'll still qualify for Medicaid if you're not working. But if you're an able-bodied person, to get Medicaid now, you have to work at least 80 hours a month, and that's both House and Senate, in order to get Medicaid benefits.
Right. And we don't know, though, are they going to be adjusting the Medicaid levels because of that? Because right now you're at, I'm just making these figures up, 20,000. Well, are they going to bring that up to 30,000 to qualify for full benefits? That's what we got to see, what all the pieces are. Don't just complain without knowing.
But I guess, and the other thing is that I just want, oh, cripe, we got the news. I got a break for the news. I'm Esther Gullius, the tax lady. See you on the other side. Hey, this is Esther Gullius, the tax lady. I'm so sorry for the abrupt ending just before the news. I was just going to go off and talk about what some of these commercials on TV and how misleading they are, and so I apologize for that. But again, getting back to Medicaid, we are paying tons of money to people that are here illegal for their free health care, and Medicaid is the best health care you can get. There's no deductible. You get the full range of benefits from prescriptions. It's unbelievable. So that's why they capped it. And so when you hear these people talk about all the people that are going to lose their Medicaid, it's not American people. It's people that are here illegally. So that's that. The other thing is the Senate. Tax-free tip income and overtime, they have it capped at $25,000.
Okay.
Collectively. So, whereas the House version was far more liberal, I think it was $25,000 each. And again, these are increases to the standard deduction. So, or the itemized deduction. So. That's what they're proposing. Here's the other interesting thing: the car loan interest is deductible. The Senate has capped it at $10,000. So again, and that's an itemized deduction as far as I know, unless they're going to make that an adjustment.
I mean,
income.
Also think about it. That's a lot of interest. If that's $10,000 a year, not $10,000 for the life of the car.
No, it's $10,000 a year.
So
your payment's like $900 a month, right?
Just for interest,
right? So that's the proposal by the House. Something that is being eliminated, and I think you guys should pay attention, is the energy credits look like they're going to be phasing those out. So this may be the last year that you're going to get any credit for energy conservation for windows, doors, furnace, hot water tank, or insulation. So think about that. And the QBI, they were going to move the qualified business income deduction to 23%. The Senate kept it at 20%. And again, this has all got to be negotiated back. And then, as I said, all the tax changes are going to be permanent from when they were first done in the first Trump administration. So that would be a permanent change. So
permanent, yeah, okay.
Well, that's
Until
permanent
they
until they
change.
changed it. That's true. That is true. But anyway, I'm Esther Galias, the tax lady, 8030930, 8030930, star 930 in a cell phone. Text at 716-8030930.
Yeah,
So what do you feel about these?
well, they'll all help everybody. I mean, you just got to put your pen to paper and see what it's going to do for you.
For you. Right.
I
was counseling with a couple yesterday because he just retired. And I said, well, and because he's already having withholding, right? I said, I'll tell you the truth. You're both over 65 with the increased standard deduction, because they're going to increase it again. And the potential to either have $4,000 or $6,000 apiece in deductions. I said, you guys will never pay taxes again, or until they change the law, right? But but it gives you a great opportunity. Think about this: if you find out you owe no taxes, but you have a taxable IRA out there, it gives you an opportunity to move it into a Roth, tax-free.
Yep.
So those are things that once this thing is hammered out completely, and they're saying 4th of July, I hope so, then we can really put our teeth into it and say, if you do this, then this will happen. If you do that, then that'll happen, and we'll get you up to snuff. Right. All right. And the other thing I have written down here is this mid-course correction. You should, this weekend, think to yourself, I got to pull out my paycheck, my pay stub. Of course, we don't get stubs anymore, do they? And take a look at what my withholding is, federal and state. Give EG Tax a call. We'll take a look at how close you are.
Right. We can project and see and run the numbers and say, you know what, take a little bit extra out. If you don't want a big refund, take a little less out.
Right. Or if we find out that these tax law changes are in effect, we can tell you how much to stop withholding.
Right.
Because you're going to save money. Something the financial guys were saying was that they don't know where the money's coming from. I mean, to put it nicely. And it's true. I've wished that I know how Elon was feeling about the budget deficit, the big budget deficit. So some of these changes, you just wonder where they're getting the money from.
Right.
So I see we have a special guest on the phone. Right? All right. Hello, Tiffany.
Hey, guys, you sound wonderful.
Well, thank you. We were talking about your daughter's shower tonight.
Oh, I know. I Wegmans, I just spent $580 at Wegmans, so I just gave a little stock dividend or something. They gave me, I don't know what the heck. But I was thinking, I had a caller this week, and he is a federal employee, and he just got the windfall where he now will get Social Security of about $1,200 a month, and he's a married guy, and his wife works and makes around $80,000, and he's got a federal pension. And so he wanted to know about what he should do in withholdings, because now he's privy to the Social Security that he used to not be privy to. And so I told him about the W-4V, but the truth is I said after the changes, it might not be where you have to do withholdings of 10%, and his wife also gets Social Security. But, all those federal employees who used to not get Social Security, and they have a federal pension.
Right.
And so
because they didn't qualify because of the federal pension, but they changed that law back in January.
Yes. So And did they get backup? With
Yes,
Social
they got
Security?
A year's
they
worth.
got 1 year's worth of settlement money on the Social Security that they didn't receive.
Yep, that's what he got. So he said, "Yeah, but don't forget to take into consideration I got 13,000." I go, "Yeah, but when do you get your Social Security for this year?" He goes, "It doesn't start till June." So I still said $10,000, 10% is okay.
Well, I
And
really
I
think
also
that
told
this.
him about the IRA from his wife's wages to do a spousal IRA.
Well, I really think what's going to happen this first year, depending upon what really comes out of Congress, is that it's going to be a learning year. So people are probably going to get a lot larger refunds because they're still going to keep withholding at the rate that they were at before they changed the tax law.
That's right. That's
You know.
right. So it's like we're advising people, but we're just not quite sure, you know?
Right. Well, believe me, it's going to come out to be close here. It's definitely. I know it's going to happen. That's for sure.
Yeah. Well, anyways, I'll see you guys soon.
All right.
Great
We'll see you at the
show.
shower.
Thanks. Bye.
Thank you. That's Tiffany Fabian, Mr. Fabian's wife.
That's right. That's right.
And my daughter. All right. I was with somebody this week. I was doing his tax return, and he's a chronic balance doer. He owes money every year. He owes a lot of money every year. $10, $15, $14, $18,000, and collectively he's in the hole about $80,000 right now. And the penalties and interest are accruing. And the interesting thing is, he's a financial person for a major manufacturer, major business, and you would think that he knows better. But here's the thing: I said to him, you know, because now they're going to go after him. And so the first thing I said was, maybe we can do an offer in compromise, which would be an opportunity to have the taxes withheld, not pay taxes. You'd pay pennies on a dollar if you qualify. If you can establish the fact that you couldn't pay the taxes, you didn't have enough money. But in his situation, he makes a lot of money, so he won't qualify for an offer in compromise. He could do a bankruptcy, and everything over 3 years old could go into the bankruptcy.
Yep.
But I said, if you did that, you have to get straight. And so I suggested that he take the money out of his 401k. He's over the age of 59 and a half. He won't have any penalty, and he can get paid up and move forward. But if you're a chronic balance due person, you really have to either change your lifestyle or change your withholding. But you're going to end up being very sad here one of these days when they come after you.
Right. Because they will. They now go after people's Social Security to garnish that, and so you got to be proactive, and you set up your agreements how you want it, so they don't set it up how they want it.
Right, that's exactly right, and the penalties and interest are just crushing. This guy will never get out from under if he doesn't do his
something.
401k.
Yep.
So I said, change your lifestyle, sell some assets. If you have, many times you'll find somebody that owes money and they have the money in the bank to pay it.
Yeah.
And they'll say, I don't want to take the money out of the bank. Well, this is not a good look for you, I'll tell you, because the penalties and interest are so onerous that anything that you think you're making in the bank is going to be well offset by the penalties and interest.
Right.
Okay. I'm Esther Golias, the tax lady, 8030930, 8030930, star 930 on a cell phone. Text us at 716-8030930. We're going to take a short break. We'll be back on the other side. Hey, to us, you are family. I'm going to tell you, if you open up that mailbox and you got this thing from the Internal Revenue or State of New York and you don't know what to do, you should call EG Tax. We do not charge you to explain what the bill is, to point out the fact that it's probably wrong or partially wrong, and we will help you.
That's right. That's right.
I had a lady yesterday that got a bill from New York. It's a warrant now for New York State from 2014 and 2018 because she didn't pay New York State taxes. She was living in Canada.
Yeah.
And so we asked for an appeal because she was using a New York address, but she was living in Canada. She worked for the federal government, of all things, and the federal government would not mail it to Canada. So she had to get an address. She was from Western New York, so she used a New York address for a P.O. box and New York State, and she just kind of let it go because that's, like I said, some people just put their head in the sand. Well, now it's a warrant, and they're going to go after her house. So, but I wrote a letter to New York State. I said, we'd like an appeal. She never lived in New York State, nor did she make work in New York State. So she owes no New York State taxes. But if you're getting these kind of letters and you think because I see this lady on TV all the time that says that she was worried about the taxes. One of those tax forgiveness firms, because it can just be just because they don't come after you right away with the handcuffs, it doesn't mean that they're not planning on it. And so you wanna be proactive.
Right. Exactly.
And EG Tax will help you be proactive.
Yep. And speaking of letters in the mail, I just want to say this to our listeners. I did have somebody tell me they got a letter in the mail, but it wasn't from the IRS or New York State. It was supposedly from Synchrony Bank saying, we're going to close this credit card on you. And so that person didn't call the number on that letter, took out their credit card, called that number, and they're like, what? We didn't send you that.
It was a fraud. Right?
It was another fraud, another scam.
It is absolutely terrible. As a matter of fact, today I saw that, who was it? A great big firm, I don't remember which one, I saw it on the news this morning, had a data breach of like 3 million people. So they have all the information. I'm going to tell you, if it smells rotten or it's making you afraid, call for a second opinion. Don't call and give people your social security number, your credit card numbers, because there are people that are in this world that have nothing better to do than to go after your money.
Or if you get an email and it says, "Oh, we're processing your refund. Please call us with your account information." Well, first of all, did you return something? If you didn't, it's a scam. Don't click on emails that you don't know what it is.
Yep.
Just delete it.
It is absolutely horrifying because people people call on the phone all day, hanging up. They're scammers. People online are scammers, and you don't know who to trust.
Yeah.
And I was telling a client of mine yesterday, I said, nobody cares about anybody anymore. There's no customer service.
Yeah.
So you're used to talking to an AI, you know? Anyway, let's go to Doug. Hey, Doug, how can we help you, sir?
Well, I have a question about estimated tax payments. But first, I want to thank you for your weekly show, which I enjoy to the utmost.
Thank you. That was very nice of you, Doug. Appreciate that.
Well, when I filed my return, I, of course, got my little tickets from the IRS showing how much they expect me to pay in estimated this year.
Yep.
I am considering scaling down my business a whole bunch. So therefore, at the end of the year, I would owe less in taxes. My question is, am I still required to send in the amounts shown on the slips from the IRS? Can I send in a lesser amount, or do I have to file something to let them know it will be less?
All right. Well, first of all, that's why it's called estimated tax payments.
Right.
So in an estimate, it's what you think the result is going to be, basically split up into 4 equal payments, and that's what you're supposed to send them. So it is your estimate. So if you have the time to construct what you think is going to be your liability in 2025, and maybe you've already paid in enough that you don't have to do the last 2 payments, remember, it's an estimate.
All right. So then I will
And you
not
don't
hear from
and you
them
don't
if
have
I
to write them a letter that says, "Oh, this is Doug from Lockport. I'm changing my estimates." They really don't care. They just
All
are
right,
looking
that's
for
what I
your
wanted
money.
They just cash your check.
Right.
Exactly. All right. Thank you very much for your help.
All right. Thanks, Doug.
Bye.
All right, but that's true. They only want your money when it's tax time. If Doug were to find out, oh, he owes $5,000 and he didn't make his estimates, then they'd care.
Yep.
But if at tax time, Doug paid in estimates of $2,000 and his liability is $2,000, they're good. They're good. They don't have any problem with that. Okay. I'm Esther Galice, the tax lady, 8030930, 8030930, star 930 on a cell phone. Text us at 716-8030930. Changing your W-4 is your steering wheel to the amount of taxes that are being withheld from your paycheck.
Right.
Right? That's what steers the car. If you're getting gigantic refunds, and understand that this year, if you have Social Security income, you have tips, you have so there's tip income and overtime, which is a big thing. Your tax bill, and children under the age of 17, your tax bill is going to be less.
Potentially.
Well, it probably will.
Yeah.
I mean, something's going to happen, and I do think your tax bill will be less. So as soon as we find out exactly what they're going to change, you might want to change your W-4 at work so that they don't take so much out of you, especially if you find out that you're going to be paying $4,000 less this year than last year. You don't want to send in all that money to the IRS and then wait for them to send it back.
Right. Yeah. Yeah. I mean, even if you just get married, like my daughter's getting married this year, look at the W-4, because you really have to fill out all the pages, because there's more than one page now on the W-4, to make sure you do it right, because there is sections that say, if you're married, does your spouse work? If yes, go to page 3 and 4. And you have to then say, take extra out, because if you don't say your spouse works, they don't know. So they're going to say your spouse doesn't work. So they're going to withhold very little compared to how much it should be, because when you combine. So you really got to look at the W-4. So if your life is changing, to make sure it's right.
Or maybe your life didn't change, but the tax law changed.
Yep.
It's absolutely important that you don't overpay your taxes. You don't want a gigantic refund.
Right.
I mean, they're paying you zero on the money.
And I hate to say this, but identity theft is big.
Yep.
On a tax return.
Yep.
But if you change those identity letters that people are still getting, prove your identity
from the federal government.
They only do that to people who are getting refunds. So if you don't want your refund delayed, get your money throughout the year, and then pay them $100 come April 15th next year.
Right. So what Chris is saying, that identity letter comes from the IRS, and so they might be sitting there with your $10,000 refund with their arms crossed, saying, if they don't send this back to us, proving who they are, well, then we're not going to send them the $10,000, and that happens a lot.
Right. Yep.
Okay, we got a text, right, Chris?
We do. Hello. You give great information. Do you think any tax changes from the bill will be there for 2025?
I do. It's interesting because that's another thing that I heard is they want to get this thing passed and make it retroactive.
Right. Yeah.
At least parts of it.
Right now,
I'm sure
they're
there'll be some
it's
pieces
20...
and parts that it won't be. But they were saying that they wanted to get some of these things, I think specifically the child tax credit.
Yep. And now, also, I believe the U.S. Senate bill regarding auto interest deduction is only for new cars, while the House bill is used and new vehicles.
Right. And again, there's going to be an amalgamation of ideas here, because after the Senate gets passed, then it goes back to the House for them to reconcile between the Senate. So believe me, I'm hoping by the middle of July we'll have some pretty good.
And it's got to be cars built in the U.S.
In the U.S., right. Again, this is
That's
all,
how it is
right.
right now. Got to see how it is later.
All right, so another big change that people don't think of is having a new baby. So if you have a new baby in 2025, that can save you anywhere from $2,000 to, if you go with the Senate bill, $2,500, and that's something
It could
in your family.
Yeah. Going to be a grandparent this year. Very excited for that. But you say it could save you $2,000 on your taxes, but it's going to cost you a lot more than that throughout the year. But yeah, no, it's a great little.
But you know,
it
back
helps.
in the day when I was a young mother,
You got nothing.
I got nothing.
I got
the
nothing.
love. I just got the love of the kids, right? But now you actually make money when you have children, so to help you, you know. And then so I told you about the energy credits, and what you should there's lots of big changes. Look at that. Okay, so just listen to Ask the Tax Lady on Saturdays. We will keep you abreast of everything. If you're getting letters from the federal or state, or if you just know that they sent you a letter and you didn't deal with it, give us EG Tax a call at our corporate headquarters. Our email address is egtax.com. Our web is egtax.com. And we're very happy to help you. Ask the Tax Lady. I will answer your tax questions at no charge. But the important thing is deal with it. Whether it's a large refund and you want to change your W-4, whether it's a letter from the federal or the state, don't just pay it. Give EG Tax a call. And, of course, we'll keep you abreast on what's happening with the big, beautiful bill. I don't know if it's so beautiful, but it's sure big. That's for sure. Anyway, until next week, I'm Esther Gullius, the tax lady from EG Tax with Christopher Fabian, and I'm wishing Grace Fabian and her fiancé,
happy Corey Stolting.
a wonderful evening this evening. And thanks for listening.